Hi, my name is Hannah, and today we're interviewing Paul. Originally from the US, he is based in Singapore and works with one of the largest Singaporean banks. His expertise include derivatives, private equity, distressed debt, fintech, and he described himself as a dispenser of financial advice. Today, he gave us his view on key trends as we emerge into a post-pandemic world.
This podcast channel is about you, successful international entrepreneurs, successful expats, successful investors. Sponsored by HCJ Tax.
So, good afternoon, Paul. How are you?
I'm absolutely fine. It's a Friday afternoon.
Right.
And as we always point out, we're near the last official days of summer here in Singapore, as if it made a difference.
Right. And for those who may be watching on YouTube or listening on one of the other podcast platforms, could you please introduce yourself?
Okay, I'm Paul DeVierno, and I work at the Private Wealth Management Department at UOB Kay Hian, which is a securities financial firm in Singapore, part of the United Overseas Bank Group. And I'm joining Darren, a good friend, here today to discuss investing for, whatever reason you have to invest for, but while you live overseas and while you are a U.S. person or a U.S. taxpayer.
All right, great. So, but just to kind of like set the scene, the world from some people's perspective, the world is facing a lot of uncertainty. I mean, we are collectively facing a lot of uncertainty. So, what do you see, given your experience and given the perspective that you have from your job or personally? What do you see are the key trends that we need to pay attention to?
Well, I've been dining out, let's say, on the last 4 years on a presentation that I went to. I guess it wasn't 4 years ago, maybe 3 years ago, from one of the fellow banks here in Singapore. And I don't want to mention to them because obviously they were kind enough to have me there as a guest, right? And they had their senior economics person going up there and talking about all the worries created for her as for the investment universe, related to all the chaos calls about Trump. She got a big laugh from the audience because she goes, "You know what I worry about?" And she flipped the slide and there was a big picture of Trump and everybody laughed. And of course, not that I'm a Trumpster, but one of the things about that was, if I wasn't a guest and I wanted to heckle her, I would have said, well, you must really dislike low volatility markets that only go up. Because although there's this illusion, or at least that Trump created all this chaos, that and when the trade war even especially got going with the U.S. Last year, after Trump had handled NAFTA and then switched to China, two of the best performing markets in the world was the United States and was China. And if you look at this year with all this political stuff going on, two of the best performing markets in the world are the US and China. So if you're kind of getting sucked into listening to CNBC in the morning and they're just moaning about all this stuff, you're really doing yourself a disservice, because clearly the market is focused in something other than all the noise. I mean, clearly there's some geopolitical thing going on. I'm not saying that there isn't something going on, and I'm not saying it's not important, but it isn't doing the parts. But the other thing, is, that really struck me and really did annoy me about this presentation from this other banker was that some of the things she said, a lot of times you think with finance, things are opinion, but some things are not opinion. So for instance, when she was talking about all the volatility caused by Trump, there's an actual formula that people in finance use to calculate volatility. And under Trump, for most of the time, obviously COVID changed everything. The markets had been remarkably unvolatile. In fact, if Trump's tweets, that was her joke. She talked about the tweets. If Trump's, can you see me tweeting or pretending to tweet here? If Trump's tweets were really causing all this volatility, right? As people in the financial markets, we should have been very thankful, because there really wasn't that much volatility, which means if it weren't for the tweets, the market would have been completely dead. So to bring the answer back, then, why is the market going up, considering that Trump is tweeting and there's all this stuff going on, is probably focusing on monetary policy. And what the Fed is doing and what the Chinese government is doing is probably going to do you a lot more benefit as an investor than worrying about these daily news stories. And the other thing I'd like to add to that, another great example of this is, I guess it would have been 3 years ago, the market was or maybe more, absolutely, what's the word I'm talking about? Preoccupied with Brexit. Brexit, it's got to be bad for Europe, it's got to be that, all this Brexit stuff. And what we learned as we studied this Brexit stuff, or was told, is that the absolute disaster would be if the UK voted for Brexit, and then instead of having a soft Brexit or a Theresa May medium Brexit, whatever she wanted, that you had a hard Brexit. Now, currently, the UK, and it could change, seems to be hurtling towards a hard Brexit.
Yeah.
But you don't turn on the television, CNBC in the morning saying, sell everything, there's got to be a Brexit, right? It's like they've forgotten that that several years ago that they were saying that this was going to be some terrible event. So it just tells you that following those news stories, is very transient, right? It doesn't, and that there's, but, and there's obviously other things afoot. So you don't want to say the market is crazy because it forgot about Brexit. What you want to say is when the market was going up and down every day with Brexit, then it was crazy. And when you hear people, complaining that the trade war, China and the US, this makes the market so risky, well, the right answer to that is the market doesn't seem to be behaving like a risky market. If you're going to argue the market is risky, you wouldn't argue it because Trump is saying these bad things that are scaring people. You would argue it's risky perhaps because people are overconfident about the markets right this second, and there's too much money in the markets and they're overvalued. That would be a reason to be risky. But paying attention to the headlines, that seems to be it has been for the last 3 years, just a loser strategy.
I agree with that. The media, at the end of the day, I guess it helps to remember that they're businesses as well, and they want to create as much excitement as they can to drive headlines, to drive clicks, to drive viewership. So they're business. And it's interesting that you mentioned Brexit. A couple of days ago, I returned from the UK after spending a month there, and it is sort of like mixed emotions to a large extent, naturally and obviously. the present pandemic has supplanted Brexit as the main point for the media, but there is, there's still a lot of anxiety and uncertainty as December approaches. But moving back to the U.S. though, some analysts make the point, and it'd be interesting to hear your perspective, that when you dissect and you take a deeper dive into, these great performances of the market indices, it's really around probably 6 stocks, and technology in general, and just 6 stocks in particular. And when you look at the broader performance of publicly traded companies, it isn't exactly as rosy a picture as is being painted. What are your thoughts on that?
Well, I actually look at it in a backwards way from that. Okay. I mean, if you're making the argument that the market is a gigantic bubble and it's way too high, we just had this terrible, what do you want to call it, pandemic, right? Mm-hmm. And the market, the S&P is at a record high, the NASDAQ is at a record high plus. Mm-hmm. Yet bank stocks are priced very cheaply. Mm-hmm. Even among the tech sector, if you're looking at stocks that really aren't part of the high growth environment going on, they're not particularly expensive. Some of them are, you'd be surprised if you're looking at your measure of expense as PE or whatever, mm-hmm. They're not nearly as expensive as you say. Mm-hmm. So if you're arguing that there's something afoot, then you could argue that there's some irrational faith mm-hmm. in a bunch of very large US tech companies that just seem to be one-way bets. Mm. And so does that, it's a really hard bet, because you could have counter arguments to it. Apple is a $2 trillion company.
Wow.
It's priced right now as if it's going to be growing for many more years. Mm-hmm. But for all we know, it could be. The people who are boosters of Apple point out it generates a lot of cash. Mm-hmm. It is growing, and that they're successfully changing their business model to being less of a company that simply sells hardware, but mm-hmm. sells a platform. Mm-hmm. And then you use your Apple phone and you buy a bunch of Apple services. So it has all this add-on stuff going. So it's very easy to get, to get all hepped up, and you listen to someone and they say, oh, the market's a gigantic bubble. Mm-hmm. But when you try to bear down and look for the bubble, it's a little less obvious. Mm-hmm. But the one thing that we can be sure of is that the US market is at an all-time high, and tech stocks have been outperforming mm-hmm. Other industries by a lot. And other than that, which would make anybody who's putting money in right now, you don't want to simply like jump in and be risky, mm-hmm. right? So, the object is to jump in when the market has been falling, not to jump in when the market's at an all-time high.
Mm. Yeah, and when it's falling like it was a bit earlier this year, then the conversation was about trying to catch a falling knife. But I've seen discussion, switching back to where we are right now, there's been a lot of discussion over retail investors. So basically the unsophisticated type of investor looking for a quick win. And they tend to use the apps, like your Robinhood, with no trade, with no fees, and sometimes just to sign up they give you stocks for free. I mean, they're heavily incentivized. But then someone else I was looking at made the comment that when you're not, nothing is free. So if you're not paying for the product is you. And it's not a secret that there are certain large funds that would sponsor or that would basically pay. I'm not saying that Robinhood, but some of these trading platforms for access to their data. so that they see the trades. And of course, like something, I think like 80% of trades right now are algorithmic anyway. So the algorithm could pick up market sentiment based on what these retail investors are, and of course see it as an opportunity. An opportunity. So in that case, how sustainable is it?
Well, that doesn't mean the market, I mean,
Mm-hmm.
obviously, well, one thing for sure is the market is not going up and up because of Robinhood investors,
Right.
because they're not capable of giving Apple a $2 trillion market cap.
Mm-hmm.
So that's the thing. Whether Robinhood investors are sophisticated or not,
Mm-hmm.
you know, we really don't know, right?
Mm-hmm.
What the logic is, or the thing, if you're going to describe it, is that, you know, we had the pandemic and all the casinos were shut down.
Mm-hmm.
You had the pandemic and all the sporting events, so you can't bet on sporting events. So people said, wow, I'll just get on this Robinhood app and I'll gamble there.
Mm-hmm.
And what they discovered is, unlike casinos or you know, sports brokers, the Robinhood app doesn't really take a big cut out of you. If the only thing you're doing is selling your data at an aggregated amount, they're really not like ripping you off, right? You may think, well, they're, you know, you may think they're being disingenuous about a few different ways they represent themselves. And actually, like you said, I don't want to speak specifically about Robinhood because I haven't investigated that much. But what I'm saying is, clearly they're, you know, they're not taking a lot out of you, right? So I don't really, you know, so these people are doing well, right? They've been making money. So we'll find out what happens if they, you know, when the market turns down and they start losing money, right? We'll find out. But my guess is that whatever makes the market finally turn down and go into a bear market, Robinhood people will be losing money, but their losses are not going to be the cause of the market going down. They're going to be a, you know, they're going to be a collateral damage because they're just not large enough to be significant. But you could see some of the things that they do. You know, there's some things, like, to people like me, that kind of, you know, do look worrisome. Like, if you're looking around for bubbles, you could look at Nikola, right? Which is, you know, a hydrogen truck company. And you look at the market cap, you know, this is a company that doesn't really do anything yet. Yet the market has given it a very large market cap. And if your logic, when you start investing basis logic that, well, Tesla has a market cap of 400 billion or whatever it is, so this Nikola at 30 billion looks cheap, you know, that's not the way finance is supposed to work.
Yeah. Okay, yeah. I mean, yeah, of course, Tesla is a whole conversation in itself, because once you take out the tax incentives, the government's, basically government subsidies, it's not yet profitable. But if I were to switch from...
Well, let me stop you there. I know everyone loves talking about Tesla, so we'll say,
Please.
One, the valuation for Tesla, it's very easy to argue it's very high, because you know, it's making it, at the end of the day, it looks like it's already pricing in that Tesla's going to be selling half the cars in the world at some time in the future. And they're going to have fleets of robo-taxis all over the world printing money for Tesla. And in actual fact, that could happen, but you don't want to buy a stock today basis that you're certain about that kind of future. However, to go into Tesla, you could flip your comment on the thing is, how come these other car makers are forced to buy credits from Tesla for selling cars? Well, because the answer is Tesla knows how to build an electric car that people actually want to own, and the other car companies have not done that. And if you add to the acceleration of electric cars, you know, if you look at the market now,
Mhm.
Tesla has a very large market cap of EVs. And
Mhm.
if you look at the trajectory of the market, that EVs, you could make a pretty strong argument by the end of this decade
Mhm.
that every car that you see for sale at the car dealership, if there still are car dealerships, are going to be EVs.
Yeah.
So if they can hang on to that market share, they're going to be a very large car maker indeed. But that doesn't mean that you should be buying their stock today at today's price.
Mm.
But anyhow, we'll move on there. So what was the next topic you wanted to hit?
No, I mean that's a great commentary, and I appreciate that. It reminded me of there's this professor who specializes in valuations at NYU. He has his own YouTube channel, and every once in a while, one of the mainstream media networks will invite him in to comment on valuation. I won't mention his name, but anyone can Google him. And you know, that's the point that he makes, and it's, you know, it reminds me of what you just said, in the sense that at the end of the day, it's a story. At the end of the day, it's a story. You're buying into a story, and your choice and valuation in that sense becomes very, very subjective, as opposed to being just mathematically objective. And it depends on which narrative you believe to be the truth. And that's to a large extent what's driving the valuations right now. But I just wanted to switch over and get your perspective on China. So to a large extent, I mean, China's also been an incredible growth story, obviously. And it's been driven by, you know, one would argue, an export-driven economic growth model. And if you have, like, Japan, the government of Japan creating like a multi-billion-dollar fund to help Japanese companies onshore, same with the European countries, and, you know, trade wars with Australia, North America. And to what extent, and potentially the attractiveness of China's exports would decline as the world's economy contracts. I mean, so it's not just the so-called Western nation plus Japan. I mean, you know, Latin America, Africa, Southeast Asia. If economies are basically on the downturn, they cannot buy China's products at least at the rate at which they previously did. And even before this pandemic, China's growth was slowing. So one would expect that it will continue to do so at an accelerated pace. What does that say? What are your thoughts on the outlook for China Inc.?
Well, I think, you know, one of the great things about kind of like, you know, a planned economy, or at least semi-planned economy, is that the people in charge are thinking about all the things you already said. Mm-hmm. And they're well aware of them, and they realize that the key is for them to develop their own domestic market. Mm-hmm. And they have been. China has a huge domestic market. But if you turn this thing around mm-hmm. to investing, right? Mm-hmm. Mm-hmm. Let's just try to see similarities of the world. So we already mentioned the banks in the US. Mm-hmm. And we said, okay, the US market's a big bubble, yet if you look at US bank stocks, they don't really look very expensive. Right? Mm-hmm. And you'd say, well, maybe it's because of the pandemic, but you'd say, no, you know, they're going into the pandemic or went in and with very solid balance sheets. So that shouldn't really be the deal. So why shouldn't their stocks be flying up like Peloton, you know, the bicycle maker, right? And it's the same thing true in China. If you go look at what is not performing in China, their bank stocks have done very, very poorly, right? And although they don't have the same sort of tech sector as the US does, of course, we all know about Alibaba and things like that. But basically investors, because of what you just said, is, well, they're determined to, you know, you got to look at companies that are going to take care of the Chinese domestic market, which is this huge market. It's got to be growing and it's a priority and blah, blah, blah. But if you go look in our stocks that fit that profile, hey, I want to invest in those, you'll discover their valuations are very, very high. So investors kind of like figure this stuff out and say, yeah, that's what I want to own. One of the things that I do with Singaporean clients, right, is, you know, one of the questions you always ask is, why is the US market so much better than the Singapore stock market? And the answer I give is really, really simple. I said, if you go back 25 years ago and looked at the top stocks in Singapore, you'd have UOB, DBS, OCBC, Singapore Press Holdings, a few other, right? Citidev, I don't know, right? If you look at the market today, you'd have the exact same group, almost. So there hasn't really been much change, and all those companies are still there. They're still making money, except for Singapore Airlines, right? You know, there isn't really that much, you know, they haven't really done all that well. Now, if you went back and did the same thing in the US, you'd be buying Exxon, GE, Cisco Systems, right? With the exception of Microsoft would have been in there, right? Which has done well. But basically, and Microsoft didn't do well for a long period of time, but basically, if you invested in those stocks and just stuck with them, you would not have done very well. But the thing is that in the US, these companies, some of them that were already in existence, but new companies like Facebook that entered the index, those companies have, you know, had terrific growth. Tesla, of course, it's not in the index yet, but it's had terrific growth. So the US market has been better because it's you know, the US has been able to, new companies have been created in the US, and they've listed in the US, and they've grown and done well in the US, right? And then to make it even more clear to what I'm trying to get with the Singaporeans, I always say, what is the largest listed company that's domiciled here in Singapore? And they, you know, they think DBS, which is the largest on the Singapore Stock Exchange. But the largest listed company that's domiciled here is Sea Limited, which is the owner of the Shopee e-commerce website, and they also own the Garena gaming website. It's actually, by market cap, it's significantly larger than DBS.
Wow.
But Sea Limited is listed on the New York Stock Exchange.
Yeah.
Right? So, so when people ask me, well, why is the US better than Singapore? I would, you know, now I say, well, if Sea Limited had listed in Singapore instead of the US, right? The Singapore Stock Exchange would have been a lot more buoyant, right? Would have done a lot better. But for one reason or another, it can't attract listings like that. These companies believe that they can, you know, that it's superior to be listed on the New York Stock Exchange or the NASDAQ. So Singapore becomes this sort of static type index, and you don't get a lot of good results here. But anyhow, that goes back to the question of, like, when people are looking at what's so great about the US, at least for the last, you know, 20 years, that's since the .com bust, that's what's been really good about the US.
So, yeah, I mean, there's a lot more liquidity there. Even when you look at the turnover of shares within SGX, it's, as you said, to use your term, is relatively static. So, you know, if anyone who invests would find themselves in a bit of a situation where if they wanted to offload something, it may not be as easy to do so as it would be elsewhere. And I guess it goes back, going back to the China thing, there's a cultural element, because like Singapore, China has a high savings rate. Whereas in the US, you know, just, you know, obviously it's the opposite. So, you know, I just wonder, and I guess at this point we're just speculating, because you're right, the the guys who are the decision makers in China, I mean, they're pretty smart guys. They're thinking long term. They don't have to think in terms of 4-year election cycles. They can take the long view, and they have even pre-pandemic realized with the slowdown that their future lies in stimulating domestic demand, even though it may come at the price of challenging the traditional savings culture, the high savings culture, to get people to spend, because to a large extent that would drive social stability as well, because they have kept that huge economy together with the promise. You know, the Americans have, we have the American dream, and China has the equivalent. You know, you have people moving from the countryside to the city, and they will get a better life and they will prosper. And that's all driven on keeping that manufacturing going. So yeah, I guess we just have to wait and see how it goes. What else we have to look forward to? You know, I know that we're speculating, depends on, you know, whether there's a vaccine or whatever. But to some extent, my perspective, and I'll just share this with you, is some of these changes will not be undone. So again, I take a long view that the pandemic has not created anything new. It served as a catalyst to accelerate pre-existing trends. So for example, something as simple as a passport, you know, like 2 or 3 generations ago, you didn't necessarily need a visa to go to the US or, you know, or to the UK, for example, or to Australia, you know. I know there were certain restrictions, but more or less you show up on Ellis Island, you do a relatively simple health check, and welcome to America. Enjoy it, you know? And then, you know, the whole concept of a passport is relatively new, but now we have passports. And then afterwards, the bar was raised and you created this visa system. And now on top of the visa system, it's been superseded. And now the the travel corridors, travel bubbles, and, you know, so it seems as if international travel has, you know, there's a step up in terms of how difficult it will be going forward. I just use that as an example of a trend that I don't think will reverse.
Well, I'm gonna stop you on 2 things. If I knew you were gonna bring it up, I could go. I'm at my home office. I go around the corner. I have my grandmother's passport right near me.
Okay. Yeah.
And so when she went to Ellis Island, yes, she had to have my mother's mother was born in a small town in Norway.
Yeah.
Which means that Trump would have liked her coming to the country if he had been around back then.
Yeah.
And she had a Norwegian passport, and on that passport there was some stamp from the U.S. consulate or some U.S. organization in Norway that was plonked on her stamp before she went on to Ellis Island. Mm-hmm. So there were, even then, when it was pretty much wide open immigration, there was some little paperwork involved. But I think the biggest difference, I think, is that people are learning it's how easy it is to work from home. Mm-hmm. And so that's not going to change, right? Mm-hmm. People also realize how much money they're saving every day, especially places like the US, by not having to drive a car back and forth. Sure. Also, people are, companies are going to note how much money they're saving on travel budgets, and they're going to wonder whether doing a webinar or whatever like this, maybe it's slightly suboptimal, but probably not, right? It's probably gets the job done as well. So you might have less business travel basis that. Mm-hmm. And then finally, you start questioning overhead, because once again, we're here in Singapore, mm-hmm. and Singapore is the regional headquarters for all kinds of different multinationals.
Yes.
And a lot of those companies are going to sit there and say, why do I have this expensive cost center in Singapore when we can handle these things remotely? So we can have people in the States, and then we can have people at the various offices. So you got all kinds of potential long-term impacts. But the one I thought you were going to bring up has nothing to do with those things, but it's just the market impact.
Mhm.
Is that if you Google for it, you'll see the charts that show the increase in online sales in the US, or the percentage, of the market share it has.
Mhm.
And you can see it was like on this nice steady increase.
Mhm.
And then we hit COVID-19 and plunk, we got 4 years worth of growth in 1 year. So the question that you would ask is, are we going to go back down to the trend line and start going up again? No one really believes that. They believe that all this did was totally accelerate an ongoing trend towards online shopping.
Yeah.
And you can see, you could see that, even in the stock market, companies that are perceived as successfully transitioning to online, because let's say you're a company like Nike, right? And you're selling the bulk of your clothing and shoes through stores, right? And then you have this other online way of selling it. Your margin for selling online has got to be a lot higher because it's more efficient. So if all of a sudden COVID-19 helps them build that business, if they're able to seize on that opportunity to get people used to buying their shoes online, because there might be some resistance to that. People think, well, what if it doesn't fit, whatever, right? That's a huge boon for a company like Nike. And you just saw it in the US stock market last night, or after the close. Ulta Beauty, came out with their earnings. And I didn't look at it very closely. Don't think there was anything very surprising about their earnings. But what they showed was that the percentage of sales that they were doing online grew much quicker than anyone expected. And of course, when, as we've already said, there's a lot of money in the US stock market right now, interest rates are zero, blah, blah. Mm-hmm. When investors saw that after the close, they just piled into Ulta Beauty like crazy. And I think the shares were up, more than 10% after the close. So yeah, all these, there's definitely, this COVID-19 is definitely going to have long-term effects on things. And you brought up the vaccination, which is very interesting, is it doesn't, one thing that you can be sure of, the market isn't really stupid. So either the market is smart enough to know that there's going to be a vaccine and it's going to work, mm-hmm. or the market has figured out there's either got to be a vaccine and it's going to work, or it doesn't, or we don't have a vaccine that works, but the world is just going to decide we can't ruin the global economy, and the world will just go back to doing their business and tolerate, this virus until it burns out. Let's hope it's the former, not the latter. The latter sounds pretty terrible. But, but you got to remember, the stock market isn't making a value judgment on mortality rates going up, right? They're making a judgment on, whether people are going to be out about and spending money and doing business.
Those are great points. I'll start with the first point you made and move forward. So I Googled and I pulled up history.com and the Ellis Island processing times. And they're saying that from 1892 to 1954, 12 million immigrants entered the US through Ellis Island, 1 million alone in 1907. And no paperwork was required, no passports, no identity at all. So this is from history.com. So the point I'm making is that over time, barriers to the free movement of people and the free movement of labor has gradually increased, both short-term and long-term movements of labor. And this is a trend that was accelerated by what we're going through. So we started off talking about the US, we touched on China, and the point you made about Singapore, I want to take a deeper dive into it if you allow us. So you're right. You know, Singapore has had an incredible time being the hub. And last year, when things started to get a bit hot in Hong Kong, I mean, me personally, I was getting like emails or text messages like almost every day sometimes with people, my connections in Hong Kong, because I was in Hong Kong regularly out of Singapore, guys from Hong Kong who wanted to relocate to Singapore and having that conversation. But we are where we are right now, and according to the Singapore government itself, they expect, by their estimates, over 100,000 expat jobs to be lost, and you assume 4 people in a household, so that's 500,000 expats conservatively going to go home. And then earlier this week, one of the ministers was interviewed on Bloomberg, and he's saying, he was asked by the person who's interviewing him about the rise in the wages, the threshold for wages to get an S pass and an employment pass. And he said the government's policy has been pre-pandemic, and it has been accelerated now to raise the standards, and they're chasing quality over quantity. And I tie that into the point that you've made about technology. Well, before, I know with me, I had my clients in Indonesia and Malaysia and Manila that insisted on seeing me every month. You know, that's the basis of a relationship. Now everyone is comfortable with Zoom. So you're right. So why do we need a high cost HQ in Singapore, for example? And then if we look at the neighboring economies, so especially like your commodity driven ones, so like your Indonesia and the Philippines, and even to a lesser extent, to a large extent, Australia, they were riding the China train. So there was, there's great demand. So the commodity prices were going up because of feeding the China machine. So with the slowdown, the economic contraction is going to be, it is already observable, and there's some hints of social instability in the Philippines, for example, riots and bombs or whatever. So that's going to continue going. So what is your outlook, and what are your thoughts about Southeast Asia?
It's basically, this place has a large population, a relatively young population, although it's older than it was before and getting older. So it has a very good future. And China, is going to continue to grow. It's 1.3 billion people, and that's, that's going to be great for Southeast Asia. Mm-hmm. The question always is, when you're doing an investing, right, mm-hmm. is that you're not investing in the future of a country. You're not investing in that. You're investing in specific stocks that mm-hmm. operate their business and are listed in those exchanges. Mm-hmm. So, from my perspective, I don't really spend a lot of time wondering whether, how big a success Vietnam's going to be, mm-hmm. or the Philippines or Indonesia, right? What I kind of more focus on is, well, what are the stocks that are listed in those countries? Mm-hmm. And do those stocks have good prospects? Mm. And that's one of the things that I learned just being here in Singapore, because mm-hmm. if you're kind of in the little bit of the Singapore expat community, you will meet people all the time here that are doing very, very interesting things, business-wise. Mm-hmm. And you're like, wow, this is a great dynamic economy.
Yeah.
But none of those things they're doing has anything to do with the Singapore Stock Exchange.
You're correct. That's so true. Yeah. And that leads me to another. Again, I'm not moving on from the point about the expensive whatever in Singapore, because that to me was one of the fascinating things about being in Singapore. When before this situation happened, I was out every evening. There was always a seminar. There was always a networking event. The chambers were always doing interesting stuff, or private wealth entities like yourself were always giving interesting seminars. And it's not just the information sharing, but the network effect. I attended one of your seminars and I sat next to this guy and we had a great conversation. We exchanged business cards. So that's a connection, right? I go into Starbucks in the CBD and you're in the line and you start up a conversation. That could be a future client. That could be a future collaboration. So there was that whole network effect, social capital basically. My question, I don't know the answer. I genuinely don't know. I'm wondering if it is that the social distancing rules continue, and as not just Singapore but other major economic hubs are saying that work from home should be the default. What does that do for us in terms of creating opportunities for new connections?
I didn't think. I'm just saying, like, if you're a company, you're got to look at the bottom lines.
Mm-hmm.
You have to, like I said, you just have to remember, like, if you're talking about a big, European or U.S. company putting a regional head in Singapore, they're putting that location here because the legal structure makes it easy to do, and there's great connectivity here, right? But they're not really doing that because they give a hoot about the Singapore market. And I'm not talking about the stock market here. I mean, this is just a small country, so if you're running a regional office here, you may be thinking about India, even people who focus on India might be located here, where you have 1 billion people living there. You have a huge population in Indonesia. You have a very large population in Vietnam, and you stick this headquarters here in Singapore.
Yeah.
So when you when you decide, hey, I have this expensive headquarter in Singapore, you're not necessarily discounting the idea that you want to have people running about, but you could say, well, maybe we can have our people running about from offices in Jakarta and offices in Ho Chi Minh City, right? Then why do we need to have this sort of edifice here in Singapore of, kind of becomes another layer of management and bureaucracy for the company. And when they set it up, these firms knew it was another layer of management and bureaucracy, but they felt they needed that other layer of management and bureaucracy. And what I think, what I was saying is, with all this interconnect, all this Zoom calls and everything else, you're going to have a rethink on whether you really need that. And at the end of the day, look, if you've located here and you figure that your main market is Indonesia, right? And your management team just loves living in Singapore because they love going to the American club and their kids like the American school, and that you enjoy the restaurants here, right? Is that guy really the guy you have running the office here, right? Really the guy that's going to really build out the Indonesian market for you? Probably not, right? You want you want your guys to be located there and focused and know what's going on in the ground. But so I think there's, I'm not saying that everyone's got to be shutting down their offices, but companies will look at, it's as simple as this. I have one friend of mine who said he's worried about his job. I really don't think he needs to worry about his job, but he's, has a job that's similar to me, where he just says a bunch of nonsense about financial market, and gives people advice and does presentations and PowerPoints and points to things with laser pointers. And his firm has him traveling, all the time around Asia. He's traveling a lot. And he said, I'm worried that someone's got to look at our P&L and they're going to see our P&L jumping. And they're going to say, why is the P&L jumped? Well, it's jumped because this guy who had this ginormous, travel budget, right? All of a sudden isn't traveling anymore. So we went up by exactly how much we saved on this guy's travel. Why do we need him? you know, those are all these little micro decisions, but, you know, companies are, companies are not stupid, right? So they notice these things and they make improvements, right?
Yeah.
Companies are only stupid when a company makes a bad decision, because people who are trying to move up in big bureaucratic organizations usually don't jump up and say, oh, look at this bad decision I made, we have to reverse it. So they normally try to cover up the bad, they normally say, no, it wasn't a mistake, and they keep it going. But when the new guy comes in, he'll see the mistake and he'll clean it up, right? And what you have to hope is that the old guy who made the mistake doesn't get too big a promotion, so he can mess up things further up the ladder.
Okay, so what I'll do is I'll continue that theme, but I'll kind of pick it up and I'll put it back in the US, because I want to end our conversation back in the US where we started, right? So going back to the whole networking effect, the whole idea of social capital, it's intrinsic when you look at the history of Silicon Valley, because we started off talking about the tech stocks. For example, the PayPal mafia. It's like so many of them went on to do amazing things. Or the guys who were early into Facebook. And one of the funds that I follow relatively closely, is Chamath Palihapitiya, the first CTO from Facebook, who's created his own $1 billion fund and is doing interesting stuff. I think including, anyway, but so my point is there's something magical about getting these sort of related companies in geographical proximity to each other. Myself, I worked for a tech company just before I moved to Singapore 7 years ago. And the company I won't mention which one it is, but it's a pretty well-known one. And I was splitting my time between London and Seattle. And when I was in London, there's a technology sort of hub around Shoreditch. After work, you go out, you're gonna meet people from other tech firms. Obviously in Seattle, we are just hanging out in a restaurant, and we're on this table, Amazon is on that table. Of course, all the Microsoft guys are over there. And one of my team members eventually went to Amazon. It's so easy. It's so easy because there's movement of people and ideas. And that creates synergy. And now when you have, fast forward to where we are right now, and you have Facebook or Salesforce or whatever saying, well, you know what, it's going to be work from home at least until next year, next summer, and then people figure out, well, I don't need to live in the Bay Area anymore if I'm working remotely, right? That high rent, I'm paying $3,000 for a shoe box. And then I'm just saying that, and perhaps there's no answer, we just need to wait and see, that this may have implications for future innovation clusters, like we have in Northern Italy with high fashion or luxury brands in Paris. That there's that synergy that's going on when you have the exchange and movement of people. The average employee at Google, their tenure is 1 year, because there's so much movement around. Google in the US, Singapore is different, right? Google in the US is 1 year. So yeah, I'm just throwing that out there. And now that I've moved the conversation back to the US, my final question is, what are your thoughts on the upcoming elections?
Well, my thoughts are,
yeah,
these are what, like, I kind of start off by saying is that when you watch financial television, this is exactly what they talk about all the time, but it doesn't really help you make good investment decisions, right? But people enjoy it. So what, the Biden, in my view, was he's a weak candidate, right?
Yeah.
And so Donald Trump, if it weren't for the pandemic, would have beat him quite easily.
Definitely.
But because of the pandemic, and there's a general feeling things aren't running the way they should in the United States among American voters. And so there's a logic, they have a logical inclination saying we need to have a change.
Mm.
So this, so Biden right now has to be the favorite. But it's going to be just like last time, it's going to be close. And what it means for, markets, or, when people, it's very hard to say, because Joe Biden he's an incrementalist. He's, so he's not going to do a bunch of policies that are going to throw the market for a loop. From a tax perspective, right? If he unwound all the taxes, right, that with tax cuts that Trump did, theoretically it would take 10-12% out of earnings. So that's bad for the market. But of course, the US has this big, gigantic budget deficit. So, it could use some extra taxes. If you look at the percentage of US revenue that goes to the US Treasury from corporate income tax in the United States, it's very small. It's very small relative to what Singapore gets. So there's definitely reason. So what you would hope, and then so you say, well, okay, let's just play this tax thing back, because this is the most obvious event for the market. You would when before Trump cut the taxes, you were seeing U.S. companies try to move their domicile out of the U.S. In order to, because the U.S. Highest tax rates were too onerous. So that was something that needed to be fixed. And if you remember the way tax was originally touted to us, it was tax reform. So basically you had this really worst of two evils in the United States, where the government wasn't collecting much money because of all the loopholes and things in the tax code. I don't know, you're a tax person. Do you like the word loopholes? What do you call them?
No comment. You go ahead.
No comment. Well, all those things in the tax code. And then, so you weren't getting a lot of money, but at the same time, you had this high top tax rates, which discouraged investment and all this other thing, and was also trying, encouraging people to move elsewhere, right, or corporations to move elsewhere. So you had the worst of both worlds. So in the so there was definitely a strong reason to lower the top marginal tax rate and simultaneously remove a bunch of those loopholes, right? So that the government, would roughly get the same amount of tax as it did before, but it would eliminate, the problem of having too high a top tax rate for corporations. But of course, they didn't do that. They kept all the loopholes and stuff and just pretty much lowered the top tax rate. So what you would hope then with if Biden wins and the Democrats won over the Senate, that would be an example where they have a second bite of the apple. So they could get the tax reform, this time do true reform and get it correct. Meaning the tax rate competitive, but eliminate a lot of those loopholes so you get the revenue. But our experience on step one with the Republicans was bad, and we can pretty much guess that the experience on step two with the Democrats will be equally bad. So we don't know what we're going to get if the Democrats win. But the one good thing is, like I said, Biden is an incrementalist, and if he's told that a certain tax bill will make the stock market crash, he won't be inclined to support it, right? So so whatever comes out will probably be fairly moderate and won't be that big a deal.
Yeah, I mean, that's a fair point. That Biden has said it's on record that he will reverse much of the 2017 Tax Cut and Jobs Act. But to your point about local governments, I think again this is a trend that existed pre-pandemic. That certain states, certain local municipalities, certain cities, they were already struggling in terms of their budgets. And obviously it's been kicked off the edge right now, and things are in dire straits for, for some of them. And they have no choice but to push taxes up. So even if the federal government can mess around, because at the end of the day, they have a printing press. So, but the local governments, they cannot. And already we're hearing murmurs in certain states, for example, California, the biggest state, that, they're looking at a wealth tax. And, everyone is pointing fingers at them, but they're not going to be the only one, because, everyone needs to raise money. And so there's that aspect of it. And then secondly, just taking a historical view, again, looking at the big picture, after Reagan's tax reform in the 1980s, taxes, we've got accustomed to, from a US perspective, historically low tax rates, forgetting that in the middle of the last century, tax rates of 75, 80, even 90% were not unheard of. So the question becomes, is it a return to what once was, in general? Because, the money needs to come from somewhere. If it's, I think it's definitely going to be happening at the local level. And then we can have a question mark over what's going to happen at the federal level, depending on who comes into power and what they're trying to do with the US dollar. And if it is that, on average, taxes are going to go up for American businesses, American consumers, what does that say about retirement funds? So like 401ks, because the deal is, I'm going to defer paying taxes on the idea that is going to be lower, right? In the future. So what are your thoughts on that?
Wow, there's a lot to unpack there. The
Yeah.
first problem with 401ks or IRAs is originally it was thought that this was going to be a democratizing thing. The common guy would get this thing to encourage him to save, and he'd have more money. But, what we know is that a small, that the majority of the money saved in those 401ks and IRAs are from higher earners who have very large amounts of money in there that they put away. Yeah. So you're giving this tax break. I think the extreme one, I don't want to beat up on poor Mitt Romney, but I think there was some you could try Googling there if you want. There was some you already corrected me. I'm going to show you my grandmother's passport someday, so we'll see we'll try to figure out what she needed when she came to the United States. But anyhow, to go back to the Mitt Romney, it was some extraordinary, like over $100 million or something, or close to $100 million in his retirement savings account. So that that basically it wasn't a product for the proletariat.
Yeah.
So there's a very definite argument that you could make that perhaps that needs to be rejigged. So the tax saving benefit of a 401k, maybe it's available to everyone, but it can't be levered up to some enormous amount, that it's in the form of some sort of tax credit rather than, the system we have today. So that would be the first thing that I would say to that. But monkeying around with stuff like that is very, very hard. Look, when when Trump was cutting taxes, right? And he had just won this election, and the Republicans controlled both the House and the Senate. And he was at least at this time a popular president. And he basically asked them to remove the carried interest. It's not a deduction. What's the word for carried interest? Classification. What do you guys call that? That carried interest, if you're a hedge fund or a private equity fund manager, gets treated as a capital gain rather than ordinary income.
Yeah.
Right? It makes zero sense. The only people who make a lot of money off private equity and hedge funds will they'll make an argument that this is, they're investing somehow, but in reality, this is fee income. And he asked them to remove it, and they just didn't have the courage. They didn't do it, right?
Yeah.
So with that one, which I view as pretty egregious, right? The idea that they're going to monkey around with 401ks and IRAs in any significant manner, you know, I'm pretty skeptical of that. But as I said to you, there's definitely room for them to do it, because the 401k and IRA are not really, they've become something very different from what they were originally intended to be.
Yeah.
And having said that, you know, we should say, because, you know, we're kind of here in Singapore and we're talking about US and American taxpayers here in Singapore, right? I mean, this was one of the things that we were discussing before, is not, you know, when I talk to Americans here, I always ask them, you know, do you put money in an IRA every year? And the ones who work for real American firms are usually given the opportunity to put money into their 401k that do. But then I'll say, well, do you file a joint return with your wife? And they go, yes. And I said, well, do you put in an IRA to her to save money? And the answer is, oh, maybe I should do that, but they never do, right? So I figured we'd end, since it's supposed to be about investment and tax advice.
Yeah.
Let's just, we'll ask you to cover things. So let's imagine we have this guy, and a typical American like that would be in a pretty, his marginal tax rate would be fairly high, even though his effective tax rate, just like it would be low because he works overseas. So I just wanted you to say it so it's not too big. So if he put in, what's the maximum you can put into an IRA now? Is it $7 grand or $6 grand? $7 grand. Oh, it depends upon if you're 55 or over, or 50 and over. So it's $6 grand. How much will that save you on taxes?
I don't know.
You don't know. Well, anyhow, when you know, most of the guys I know, you know, when you try to kind of puzzle it out, it'll probably save them $1,500 on taxes, which is a good number, but yet no one does it. And, you know, and so that's one of the things that, you know, I kind of wanted to end that, you know, I want to make sure we touch during this thing, that Americans living abroad have very complicated tax issues that normally only rich people have. Right? You get average run-of-the-mill Americans, and they're left with very complicated tax issues that only rich people have. And there's usually substantial opportunity to, you know, improve upon your tax return and manage your affairs better. But a lot of people here don't bother to even try to think about it. They're just afraid of the IRS. They want to give their return to someone who'll fill the return out for them, because they're not going to do it themselves because it's so complicated. And if everything turns out they never get a letter from the IRS saying they're angry, they're very happy and relieved. So they don't really think about putting money into an IRA, but they should. And look at it this way: Mitt Romney obviously gave a lot of thought on how to get more money into his 401k.
So I checked when you asked, it's 102 million, and this is back in 2012 or something like that. So I mean, to your point, he's obviously put a lot of thought into it and taken a lot of great advice. But you know, I do have this conversation with some of my clients, and you know what? Well, by my license, I can't give investment advice, but I have conversations around the tax implications. So I swim in my lane. So I say, well, you know, this retirement, I mean, if it is a regular 401k, depends on what it is, but it's premised on the idea that taxes won't go up significantly in the future, and that when you pull it out, after retirement, you're going to be paying a lower marginal tax rate when you pull it out, right? After you've had the benefit of compounding, obviously. So the market will do what the market will do, but the question is, and I don't have the answer. I'm not a fortune teller, but what will taxes be doing in the medium to long term? And that's something that each person has to answer on their own. But stepping back and looking at the big picture, you're right. There is value in engaging advice from people who have that skill set to look at ways of minimizing your tax burden and helping you fulfill your financial goals. And your financial goals will be unique to you. It's not one size fit all, but it's a conversation worth having. And speaking of conversations, Paul, thank you for your time. Thank you for your insight. As always, I enjoy our banter. For those who are listening, those who are watching, we do this all the time and we have a lot of fun. It's just that we've now, decided to record it. But Paul is a guy, I always enjoy having great conversations with. I learn a ton from the conversations. Thank you, Paul.
Okay.